Hello and welcome to the show. I'm Puneet Wadhwa, and today we have Jitendra Gohil, Director, Global Investment Management, Wealth Management India at Credit Suisse with us today. Are the layoffs that we have seen across new age companies in the US and in India, are they in anticipation of a recession or are they a fallout of the recession that has already set in?
There are two parts to it. One is in Europe. Our house view is that definitely the recession will hit hard. So in UK and Europe, we Eurozone, we think that the recession is already there, and probably that's the reason why we are seeing some layoffs. In US, obviously, we are expecting some kind of slowdown because the interest rates have started moving up, and Fed is very committed to bring down inflation. And without slower growth, we will not see inflation will come down in US. So yes, there will be some kind of layoffs in US, and it will be an anticipation of slower growth going ahead in US at least.
How the market's reacting to all this, and to what extent is all this factored in?
So market has already corrected sharply in. So you look at Nasdaq index, which is one of the worst performing US index year to date. Right? So the index is already down more than 30%. So market has already anticipated this slowdown and the kind of earnings cut that may come in. And that's why probably other companies are laying off because of the earnings pressure because of slower growth.
How are the Indian stocks reacting to these developments?
So Indian markets. So if I look at the IT stock, they're a little bit highly correlated with Nasdaq, right? So if global IT stocks have fallen, Indian stocks have also fallen, but slightly it is more defensive. I would say that most of these Indian companies are into services, right? IT services, which is more resilient. So from a medium term perspective, definitely there is a huge need for companies to spend on cloud computing, need to spend on efficiency improvement. So these companies are going to benefit over the medium term perspective. But in the near term, because the interest rates have gone up and most of these IT companies have corrected globally, we've also seen that the IT budgets might come down a bit. But we are also seeing that the attrition rate, which was a major pain point for the IT companies to come down in the next couple of quarters. So from top line perspective, we are going to see some kind of cuts. From margin perspective, probably on a Q on Q basis, we might see some kind of relief for these IT companies. So right now we are negative on IT sector. We are underweight on IT sector, but slowly, if more correction comes into sector, we will be the buyers of these stocks.
What about the consumption related stocks, Jiten? A recession is also bound to hit them.
Consumption, yes, it has already seen weakening signs. We have already seen FMCG companies are struggling, but the premiumization is continuing. Our view is that in the second half this fiscal year, if we see some kind of slowdown in global GDP and if commodity price starts to fall, there will be opportunity for margin expansion for these companies. So we are a little bit positive on the FMCG defensive consumption side, where we think that in the second half there will be opportunity for margin expansion.
At the macro level or the headline level, do you see 2023 to be a year of consolidation for the markets?
So I will break it in two parts. One is the domestic side. I think from now to let's say budget, we might see some kind of consolidation, or we might see some market may remain a little bit more volatile because there's a winter, and I think that the oil prices, how they react, will be more crucial for Indian markets, and already valuations have run up significantly for India. But we also of the opinion, if we see some kind of correction, let's say 1,000 point correction from here onwards, stocks will start to look more attractive because we are extremely positive in terms of flows coming to India in next year. So if global growth slows down and if inflation starts to fall, oil price starts to correct, then probably India's pain point, which is the energy inflation and energy-led inflation, will start to see some kind of correction in the next year. So from India perspective, we remain constructive on domestic growth outlook perspective. Only valuation is the challenge, and probably over a time, because expectation of EPS growth is somewhere around 18%. So every month, if we roll forward earnings, probably a kind of a 1.5% kind of correction in valuation will automatically happen as we roll forward every month. So I feel that yes, we are little concerned about the where the valuations are, but some stocks have corrected dramatically. Look at NBFCs. Some of the NBFCs are down at 52-week low, while the market is at 52-week high. So there will be a huge opportunity to rotate the portfolio instead of sitting on stocks which have already done so well. So in the next year, probably one has to be really nimble in terms of shifting their portfolios away from overvalued stocks to some undervalued stocks which might come into play. For example, gas utilities, right? They have corrected so much because the gas prices have gone up. Tile companies, for example, the cost of production has gone up dramatically because of higher gas prices. But if the view is that, look, next year if there could be slowdown in global economy, and if gas prices starts to fall or oil price starts to see some kind of consolidation, and there will be ease in terms of raw material availability, then the margin expansion will take care of slower top line. So we have to rotate the portfolio towards stocks which have been beaten down temporarily because of higher commodity prices.
Purely from an index perspective, will 23 belong to large caps or the smaller cap peers?
We are still bullish on mid caps. So from November last year, we have been recommending our investors to go for mid caps. We feel that still there is a lot of opportunities in mid caps. Large caps, we are a little bit neutral. What we feel is that because the valuation is high in India, there is kind of bouts of volatility expected from FPI flows. But from a domestic market perspective, there are so many structural stories that we like. For example, defense, we like urbanization kind of stories, which are represented by some of the mid cap stocks. So we continue to remain positive on mid caps, and that's our investment committee's decision to remain little overweight on mid caps versus large cap.
Thanks, Jitendra, for coming on the show today. We hope to see you soon again.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.